You might reasonably think that the maximum rate of income tax in England and Wales is 45%, currently paid by those who earn over £125,140. But you'd be wrong, because there is a secret 60% effective income tax rate that exists for people earning much less than £125,140. Today, we're going to tell you who's affected by this 60% marginal tax rate, and we're going to give you 7 ways to avoid this. To do this, I am joined by Medics Money co-founder Dr. Ed Cantello, who is not only a doctor, not only Medics Money co-founder, but also a chartered accountant and a chartered tax advisor. And the reason we're doing that is because this is a complex area which needs specialist expertise. I know YouTube loves completely unqualified financial influencers, but in our view at Medics Money, that is not the way to go. So welcome back to YouTube, Ed.
Yeah, cool. Hi, Tommy.
That was a pretty big, strong introduction for you there. Let's see what expertise you've got, because I'm going to start by asking you, what is the 60% marginal tax rate trap?
Yeah, that's a really good question. And let's start with the basics first, because a lot of people listening to this or watching this on YouTube, they're going to be familiar with those main income tax rates in the UK. So in England, Wales and Northern Ireland, those rates, the absolute rates we call them, are 20%, 40% and 45%, depending on your income. In Scotland, the rates, there are more of them. They range from 19% all the way up to 48%. But there is this additional concept that all of us need to understand, and that is the concept of the marginal tax rate. That's the rate of tax you pay on your next £1 of income. So typically, if a doctor in London, for example, is earning £70,000 and they get a pay rise, they might expect to pay the 40% higher rate tax on that additional income. But once your income hits £100,000, things get more complicated, because for every £2 you earn above £100,000, you lose £1 of your personal allowance, that lovely tax-free personal allowance that we all get, meaning that you pay more tax on this amount than you might expect. And that can create a marginal tax rate of up to 60% on income between £100,000 to £125,140. And in Scotland, that marginal tax rate is even higher at 67.5%. So quite high rates there.
Ouch. Can you explain to us why this 60% rate exists?
Yeah, absolutely. So, the 60% tax rate, it's essentially, as I say, a result of clawing back your personal allowance. It was a measure introduced by the government in 2010 to help them manage the national debt after the financial crisis of 2008. We have regular financial crises which require the government to try and get more money. And in this one, they introduced this clawback of the personal allowance. So as your income surpasses £100,000, your personal allowance, as you say, it's worth £12,570 for most people. That starts to disappear, as you said, at a rate of £1 for every £2 over the threshold, and that increases your effective tax rate. Thinking about what this looks like in real terms, imagine you're earning £100,000 and you receive an additional £500 of income in the tax year. Well, that additional £500 will attract income tax at 40%. Let's say we're in England at the moment. That will attract income tax at 40%, but will also mean that your personal allowance is reduced by £1 for every £2 you are over £100,000. So in this example, your personal allowance is going to be reduced by £250. So your taxable income actually goes up by £750 rather than the £500 that you're getting as extra pay. And then if you tax that £750 at 40%, that then gives you an additional tax bill of £300. So although you're receiving an extra £500, you're paying an additional income tax of £300, and hence your marginal tax rate is 60% here. And as I say, it'd be higher if you're in Scotland. And don't forget, we're just talking about income tax. We're ignoring national insurance, which is at 2%. We're ignoring student loan repayments. We're ignoring the NHS pension, if that is applicable on that extra income. So, the cost here could be even higher.
Excellent, really motivational. We are going to get to the bit of the video where Ed tells us the 7 ways that we can avoid this marginal rate tax trap. But why don't we just get into how this impacts doctors, dentists, and other healthcare professionals?
Yeah, definitely. This higher tax rate can be particularly relevant to doctors and of course many other healthcare professionals, where their income levels often push them close to or over that £100,000 threshold, especially when we're factoring in additional work, locum work, etc., bonuses. You can easily go over that £100,000 threshold. And we should say as well, of course, to make things worse, if you have children, then crossing that £100,000 mark also means losing access to the tax-free childcare scheme, further reducing the net benefit of any income earned above that threshold. So another thing to look out for. And I should say, by the way, you may hear people talk about something called adjusted net income. And it is actually, in fairness, your adjusted net income that matters when looking at this £100,000 threshold. I should say adjusted net income, put simply, that is your taxable income less any allowable tax release to get your net income, and then there are a few adjustments for charitable donations and pension contributions that then get you to this adjusted net income, and it's that really counts for this threshold. It's basically, think about it as your taxable income with a few alterations or adjustments to that, okay?
Yeah, we've covered those adjustments elsewhere on YouTube and our website. So if you are a YouTube subscriber, hopefully you've seen that. But if you're not a YouTube subscriber and you're finding this useful, why not hit the like button and the subscribe button, and you will stay up to date with the very latest expert information from experts in the business at Medics Money. Okay, so we've covered the problem. Let's get into solution. We've got 7 ways here that doctors can avoid the tax trap. And as I said, the final way is my personal favorite for how to avoid this problem. But let's move on. And why don't you tell us about the strategies?
Yeah, of course. So let's go through them. As you say, there are 7 here that we're going to talk about. So let's go talk about number 1. So number 1 is to make sure that you're maximizing your claims for your employment expenses. So you need to make sure you're claiming all allowable employment expenses, items such as your professional subscriptions. And we know that as doctors and other healthcare professionals, we're paying lots of different professional subscriptions. We're also paying those really expensive Royal College exams. So make sure you're claiming for those, because they can be deducted to then reduce your net income. And this can help you keep below that critical £100,000 threshold, but only as long as you claim them. If you never claim them, nobody knows about them. Nobody knows that your adjusted net income, your taxable income, is going to be below that threshold. So it's really important to make sure you're claiming every penny of those allowable employment expenses.
If only someone had made a really straightforward, simple guide that could help doctors and other healthcare professionals to guide them through this claiming tax rebates process, and provided it for completely free for about 10 years now. That would be awesome, wouldn't it? Oh, wait. That's exactly what we've done at Medics Money. So I will put the link to that in the show notes below. Check out the guide, over 50,000 downloads of that now. So know that that's really helping you, and really important to just do the basics there, really is what we're saying. But doing the basics well, always a good strategy. Okay, so that's strategy number 1. Tell us about strategy number 2.
Yeah, number 2 is to make use of gift aid donations. So if you support charities, consider making use of the gift aid scheme. Donating to a charity not only gives you tax relief, it helps extend your basic rate band by the grossed up amount of your donation, and therefore reducing your tax bill. It also reduces your adjusted net income. So as an example, if you donate, let's say £800 to a charity, the charity actually receives £1,000 because the government will top that up, but you also will get additional tax relief on that grossed up amount. So I'm paying £800 to a charity, let's say, for example, the charity actually receives £1,000 because they get that top up. I get tax relief on the £1,000, the gross up amount. And it will also, that £1,000 amount, it lowers the adjusted net income. So it brings down your tax burden. It also brings down your adjusted net income. Okay, so really useful stuff here. Another thing that's very useful and very unique about the gift aid scheme is that you can also carry back gift aid payments to the previous tax year, which can be helpful if you suddenly realize, oh gosh, my adjusted net income for the tax year that's just gone just slightly goes over that £100,000 mark. You can in theory make a gift aid contribution and carry it back. Not going to lie here, the rules are quite strict. You can only do this if you claim it via a tax return, and claim it when it's on the tax return when it's originally submitted. You can't amend a tax return subsequently to claim that gift aid. But it is really useful. It is something to think about. If you find that your adjusted net income, is hovering around that £100,000 mark over the current tax year, or even in a previous tax year, there's definitely something to think about here. Gift aid can be really, really useful here.
Amazing tip, and not one that I see widely known. So really good tip that. Strategy number 3. Tell us about this.
Yeah, so strategy number 3, you've got to be a little bit careful with this one, but you can also contribute to a private pension. So making additional contributions to a SIP or a private pension scheme, it's another really effective way to reducing your adjusted net income to get you below that £100,000 mark potentially. Private pension contributions, they give you tax relief at your marginal rate, and they can bring your adjusted net income, as I say, below that £100,000 mark. So again, very useful. You've got to be a bit cautious though, due to various contribution limits, and a lot of doctors listening or watching on YouTube will know all about the annual allowance and the issues that we have with our NHS pension and those horrible annual allowance charges. So with this, it's really a good idea to consult with a financial advisor before making large pension contributions. Likewise, if you have an accountant, by the way, I would go back to the previous point. If you have an accountant doing your tax return, talk to them about that gift aid claim if that's something you want to go down. But certainly with the pension contributions, just be really careful before you make a large pension contribution to make sure you're not going to put yourself at risk of an annual allowance charge. So what I also want to add when it comes to private pensions is that we have seen people online saying that you can carry pension contributions back to the previous tax year to reduce your adjusted net income like you can do for gift aid. But that isn't true, okay? That's not correct. So definitely watch out. If you see anyone saying, oh yeah, you can carry back a pension contribution to the previous tax year to reduce your adjusted net income, that isn't correct, okay? So just watch out for that.
And again, as a non-expert, the devil is in the detail here. The more I hang out with the experts in Medics Money, the more I appreciate that. So you can carry back unused annual allowance, but that's not what we've seen in various groups for doctors where they're saying that you can carry back what Ed said. I've confused everyone there, but you can carry back your annual allowance, but you can't carry back
a pension contribution. So if I make a pension contribution in this tax year, the 2024 to 2025 tax year, I can't then claim that on my previous tax return for 2023 to 2024 to reduce my adjusted net income. That won't wash. You can't do that. You can do that for gift aid. Again, as long as you get all the rules correct, you've got to meet those strict rules, but you can't do that for your pension contribution, okay? So just watch out for people telling you that you can.
Absolutely. That's why we only use expert advisors at Medics Money. Kind of related to tip 3 is tip 4.
Yep. So tip 4 is to make sure you're taking advantage of the NHS pension scheme. Obviously, in Medics Money, we talk about it all the time. It is a very valuable tool for doctors. That pension is included when calculating your net income. So ensuring that your contributions are up to date and correctly calculated, maybe easier said than done sometimes, but correctly calculated, that will help keep your income level at the correct sort of rates and hopefully help you go beneath that £100,000 threshold once it's all calculated. So definitely make sure that your contributions are up to date, correctly calculated to keep your tax bills correct and hopefully potentially get you below that £100,000 threshold.
Awesome. Over halfway now. Tip 5 is relevant to those of you who have children.
The tip here is to plan around sort of your child benefit if you're claiming it. It's maybe less about the 60% tax trap, more about a whole separate tax trap, to be honest. Because if you have children and you're entitled to child benefit, please note that that's gradually clawed back if your or your partner's income exceeds £60,000. And it's got to be fully repaid if either income exceeds £80,000. So if your income is close to one of these limits, consider planning around it again by maximizing expenses and other deductions. Alternatively, what you may want to do, especially if you're over these thresholds, is you may want to elect not to receive child benefits, which will avoid the hassle of then having to repay it back through your tax return. Just to say on this note, it's usually better to tell HMRC that you're entitled to child benefit and then say to them that you're elected not to receive it, rather than, as we see a lot of doctors do, just completely ignoring it, not registering for it, not telling anyone they're entitled to it, just not claiming it. Because if you tell HMRC that you're entitled to it and elect not to claim it, not to actually receive the cash, you can still receive a national insurance credit towards your state pension in that instance. So if you just completely ignore child benefit because let's say your income is £80,000, so you're not going to get any. A lot of people just completely ignore the situation, but actually it's probably more beneficial to say to them, hi HMRC, I am entitled to it, but I don't want to actually get the money, brackets, because you're going to repay it, because HMRC will then register that as a national insurance credit towards your state pension. So definitely a top tip from Medics Money when it comes to child benefit there.
Amazing tip. Again, don't see that level of detail covered elsewhere. If you like this level of detail, you like going off the deep end, don't forget, hit the subscribe button, hit the like button, tell your colleagues about us, and then we can help as many healthcare professionals as possible get access to this high quality information. Strategy number 6, probably only relevant if you have a partner, but let's assume you do.
Yeah, if you're married or you have a civil partner, then try and, if you can, to equalize income between the two of you. So if you're in a dual income household, try and equalize your income with your partner. You can shift income or assets between the two of you, and potentially you can do it in such a way that ensures that neither partner's adjusted net income crosses that £100,000 threshold, or let's say the £60,000 threshold for child benefit, and so on. So in this way, you're still benefiting from allowances and avoiding unnecessary clawbacks or higher marginal rates. Look at your assets, look at what's generating income, and consider if there's a way to move it between the two of you to kind of equalize your income and try and reduce each one of your taxable income. Also, by the way, don't forget to utilize where you can your ISA allowance, because interest and dividends earned in an ISA, they will not be taxable, they will not be contributing towards your taxable income, and therefore won't be contributing towards your adjusted net income. So utilize your ISA allowance as much as you possibly can.
Yeah, and I guess we should say as well that this is in some ways an incredible problem to have. Nobody's saying that earning these amounts is not a tremendous amount of money, but we are in favor of clear and transparent taxation that makes sense, and a secret tax rate of 60% doesn't make sense to us. So hopefully that keeps the YouTube comments simmered down, because I think it's a good point. This is a nice problem to have. Okay, the final strategy to avoid this problem, which I said was my favorite one, which is essentially work less.
Essentially working less, avoiding unnecessary overtime or bonuses. Again, look, getting extra money is a nice thing to have, okay? And as you just said, Tommy, we're not here to say money isn't a good thing. It is important to get the money that you're owed, that you need. But the point is this, okay? If you're close to that £100,000 threshold, just consider carefully the impact of any extra income, such as doing that extra locum shift, working overtime, getting any sort of bonuses. Extra income, lovely, and it might be appealing, but if it does end up overall reducing your take-home pay once the 60% marginal tax rate is factored in, or you then lose your tax-free childcare, etc., just is it worth it? It's important to think about these things. What we don't want is for people to think to themselves, I'm on £100,000, brilliant, this is going to offer me an extra £1,000, that's going to be great, I'm going to get £1,000 less, let's say 40% income tax, because actually it's not going to be that. It's going to be less, basically overall 60% tax, ignoring all the other factors like student loan, national insurance, and you may lose your tax-free childcare scheme benefits as well. So, please, just, especially if you're hovering around that £100,000 threshold, just think about these things, okay? It's important to do so.
Yeah, in a logical and transparent tax system, extra work should generate extra take-home pay. Nobody should do more work and pay more tax than they would have done if they hadn't done that work. And unfortunately, as you've demonstrated today, mate, there are several situations where that ludicrous situation could occur. So we are in favor of more work generating more take-home pay minus tax. Which is, it's crazy that this tax trap exists.
Yeah, absolutely. It is crazy. So sometimes there is a potential for getting sort of non-cash benefit of your employer, time off in lieu, extra holiday days. Can they get an extra contribution towards your pension scheme? I don't know how feasible that's going to be, but I guess the key thing, as you say, is just be really mindful. If you're getting towards that threshold, what would the full implications be of getting that extra income? Those are the 7 tips. I mean, just to summarize, really, guys, there is that 60%, or as I said, 67.5% marginal tax rate that's out there. Okay, it can be really costly for high income earners, particularly for those doctors that have an income that's fluctuating or hovers around that £100,000 mark. As I say, it may be even higher than that if you factor in national insurance, student loans, potentially the NHS pension, or you lose your tax-free childcare scheme if you go over that mark. Okay, so lots of things to think about. As we said, we're not anti getting more income, and we're definitely not anti paying the tax you owe. We get that sometimes in YouTube. People say, oh, this is just a way for doctors to not pay tax. It's about trying to pay the tax that you owe, and not falling into tax traps whereby extra work actually penalizes you. That's what we're anti here, okay? But hopefully by understanding what we said today, understanding the thresholds, implementing some or all of the things we've spoken about today, those 7 strategies, hopefully you can protect your income, reduce your tax bill legitimately, and just keep more of what you earn.
Absolutely. Amazing summary, mate. If you want more of this, subscribe to the YouTube, hit the thumbs up button. I'll put some links down below and you can join our email list of 60,000 health professionals now who get regular email updates on all kinds of things related to their finances. Thank you so much for watching and see you on the next video.